welcome to our webinar on top real estate trends for 2021. I'm super excited to host Neal Baba, the CEO of Grow Capitus. And Neal really needs no introduction in the multifamily circles. In fact, in the real estate investing industry, Neal doesn't need an introduction. Everybody knows him, and he's at every event speaking about something which makes a lot of sense. So I met Neal the first time at one of these events in Houston, like a multifamily event. And I was just mesmerized, and I was, listening to his every word, like, yes, that makes sense. It was literally me. And it blew me away. So I always wanted to have Neal on one of my webinars, but never got an opportunity to. We did host Neal on a passive investor ed event we did last year. And as always, he was phenomenal, and he brought a lot of value to all of the audience. And I know some of you are on here today and you would agree that Neal, when Neal talks, it makes sense, right? So Neal's big thing is, he is data driven. He's all about data and how he can analyze those data to make good investing decisions. And I think as investors, that is super important. So today, Neal is going to talk about where we are trending as we are going through COVID and hopefully coming out on the other side, what's happening to real estate, where you should be investing in. So some of the things that Neal's going to talk about today is which states are struggling with unemployment numbers and which are largely unaffected by Americans' mass migration. Find out where they're leaving, and obviously those cities aren't going to do very well, which cities they're flocking to, and which cities offer the best investment opportunities. Also, his predictions on single family and multifamily markets for 2021 and how they'll fare in the wake of 2020, and why the stock market exploded despite so many Americans being out of work. Actually, Neal, I'm super interested in understanding this. And what is the economic outlook for 2021? And how this recession was unlike anything else we've seen, and what this means for investors like you. That's a lot of information to cover in an hour, so I don't want to waste a lot of time. I'm Kavitha Baratakke, for those who don't know me. If it's the first time you're logged in, thank you for being here. Again, this is an educational presentation. We're not giving you investment advice. It's just based on Neal's data analysis. So always consult your own people before making and do your due diligence. Few housekeeping rules. Everybody asks me whether this webinar will be recorded. Yes, it will, and the link will be sent out. Please whitelist my email so it doesn't go to your spam folder. Just some upcoming webinars that I will be hosting in the next few weeks and the next few couple of months. Feb 17th, I'll be doing a simple one on syndications. For those of you who are new to syndications and how they work, I'm going to talk about the structures of syndications and different kinds of investments that might come to your table with a syndication. So whether it's multifamily, senior living, whatever it is. So I just want to give a broader picture of how syndications work. March 4th, we have how real estate investing has changed with the new administration. That won't be the topic, but that's going to be that won't be the title, but that'll be the topic. And Anderson Advisors will be joining us for this presentation. March 18th, this is another strategy which is very useful, mega backdoor Roth. So please join us with CPA Bernard Reisch. I think I butchered his name, but that's kind of what I know. We also have Roadmap to Financial Freedom, Peak Performance Workshop with a Tony Robbins coach, Ajay Gupta, and many more. Every 2 Thursdays of the month, please join me to grow your investing knowledge. And if you ever miss my webinars, it's all on YouTube. Please go subscribe so you can be notified when I upload new content. I also put a lot of short videos on my YouTube, so feel free to go in and peek and learn whatever you want to. Also have a Facebook investing group called Purely Passive. And a lot of people know me, so I won't spend too much time. I am the principal of Cherry Street Investments. I do passive investments. I also work with infinite banking policies. And I'm also a realtor, which I don't do a whole lot of in Austin. I come from a technology background, having spent about 20 years in technology. We'll talk about the star of the show. Neal Baba is a technologist, universally known as the mad scientist of multifamily. Besides being one of the in-demand speakers in commercial real estate, he's a data guru, process freak, and an outsourcing expert. He is the CEO of Gdp Growth, which holds an impressive $250 million multifamily portfolio. And Neal is also diversifying into a lot of other newer bills now. And he treats everything as an ongoing experiment in efficiency and optimization. And I'm really intrigued by this. He also serves as CEO of Multifamily U, an apartment investing education company. If you're ever looking for event that will teach you how to invest in multifamily and deep dive, it's called Magic of Multifamily Bootcamp. It's amazing and you should check it out. And for hobbies, he's a backyard tomato farmer and a protein diet health nut. And he believes in positivity and karma, and he's passionate about the sport of cricket and the enormous potential of self-driving electric vehicles to solve the global climate crisis. And with that, I'm going to hand it off to Neal. Thank you, Neal, for being here. I'm excited and I'm looking forward to what you have in store for us today.
Fantastic. Let us get started. All right, I'm going to share my screen.
Yeah.
There we go. And share screen. I'm going to turn off my video so that I'm not blocking the screen. I have a lot to show folks, but I'm going to turn my screen back on as soon as I finish. So this is about a 45-minute presentation. Let's go. Bizarre, unprecedented, deadly, black swan, disruptive, pandemic. Overused words like this that describe the most awful year in modern history. And this makes this annual presentation much more challenging because there's hundreds of articles and reports that we've already read and digested, and we believe we found the mega trends that are going to drive your success in 2021. Enough's been said about me, so I'm just going to show you what my portfolio looks like. Half of our projects are new development. The top row are large townhome projects. The middle row and lower row are large apartments and student housing. And the last one on the bottom right is a large industrial project. I love them all, but cash flow is king. So the other half of our 18 projects, that portfolio, are ugly duckling multifamily and self-storage projects that produce millions of dollars of cash flow for our 400 happy investors. And talking about happy investors, track record matters a lot more than the size of the portfolio. So it's great that our investors are kind enough to write reviews for us once they've finished projects with us, like this from Sarah. She has 4 active projects. Take a look. She's very, very sharp. She's invested with a lot of groups, so she can truly speak to our quality and hard work. Ivan's another experienced investor. He's also invested in multiple projects. He's a very detail-oriented person. So what he liked about our projects, other than the money, is our class-leading use of data and metrics to find the fastest growing cities and neighborhoods in the US. And that's what you're going to be watching today. After some of that shameless chest thumping, let's get to the matter at hand. So no review of 2021 trends is complete without a review of the year of misery. COVID caused more Americans to move than ever before. Those migration patterns are where our story begins. And we're going to connect the patterns with some economic tea leaf reading, from GDP to interest rates to stimulus. We are going to connect it all back to real estate profits in 2021. And then we're going to get to the favorite part of the presentation, single family apartments and other asset class forecasts. We're going to share class leading data, and we're going to finish with the shootout. Best cities for real estate investment, both big and small cities that you've never heard of. I promise there's going to be a bunch of cities that you have absolutely never heard of. And then I finish the presentation by naming my favorite city. I've done this 5 times before. I'm going to name a national city and an underperforming city that I expect to do really well in 2021. This is the most boring slide of my presentation, and thanks to Kavitha, I do not need to read it. She's already said that. So let's get started. Our story starts with a flashback of how the economy did in 2020, from stock markets to crazy GDP charts to unemployment to rent growth. Let's set the groundwork for the mega trends to come. Now, I'm a real estate guy, so I start with what affects my investor profits the most: rent growth. Before the virus, rent growth in the US was simply awesome. Whether it was Class A or B or C, everything was rock solid. In fact, annual rent growth, there was annual rent growth for a record 39 consecutive quarters. Occupancy was at an all-time high. All was well And then all hell broke loose. The virus plunged us into a recession. It killed 400,000 people, caused catastrophic damage to our services industry. But for once, and this is probably the only time in my life I'm going to say this, Congress responded spectacularly well with the initial CARES Act. So with the Fed's interest rate cuts and trillions in stimulus, we saw the stock market and the real estate market go absolutely bonkers. Today, the S&P 500 is about 3,800, its highest ever, despite a second and then a third resurgence of the virus. And I know, lots of you on the webinars are going to say, Neal, the stock market doesn't make any sense. Millions of Americans are out of work, so the stock market's too high, it's going to crash. I have news for you. The stock market's actually where it should be. And I'm going to prove that to you in less than 10 minutes. So hang on for that. The first place I'm going to start digging is GDP growth. The US gross domestic product was negative 33% in Q2. That's the highest decline on record. I see that in news articles all the time. You know what I don't see in news articles is that Q3 GDP growth was not negative. It was positive 33%. 33 down, 33 up. They canceled each other out. While that may not make sense to you yet, I promise it will in a few slides. Okay, so GDP balanced out, but Neal, many industries were hit really hard. The 4 largest US airlines, they lost 25 billion. The NFL lost 38% of the revenue. So many sporting and event venues have been closed since March, but none of those was as badly hit as the entertainment industry. Both the largest and the second largest chains in the US are going to be closing. And the government responded to this incredible pain with the largest stimulus in US history, $2 trillion injected into the US economy. That's a whole lot of zeros, and I'll explain why that matters. And the Federal Reserve didn't stand back either. The Fed's balance sheet increased by a staggering $3 trillion this year. The Fed bought government debt to help the politicians pay for the CARES Act. In all, they provided 3x the subsidies provided in 2008. And then let's look at unemployment numbers. This recession was wildly different from previous ones. In this chart, you can see the first 52 weeks of the last 5 recessions, all in this cluster. As you can see, a year after they started, there were roughly 20 to 30 million unemployment claims in these 5 recessions. The orange line is the COVID recession. Only 31 weeks into this recession, we were already at 66 million unemployment claims. Sorry, that's a stunning number. Another thing that was bizarre about this recession was how uneven it's been. Hawaii is at 15% unemployment, Nevada at 13%, but there are 14 states in the US that are still under 6% unemployment. You can see them right here. Nebraska is at under 4%. Bizarre. The recovery has also been bizarrely uneven depending on education level and income. On the left, you can see that people with less than a high school diploma, basically low-wage earners, were the most affected, followed by these people with high school diplomas. And on the right side, right, when you look at on the right side, now we're looking at income. People with high incomes or medium incomes, they're pretty much back. This is Feb, this is September. They're pretty much back to where they were. It's the people below 16 bucks an hour that have suffered the most. They've suffered tremendously. So to summarize, people with low income and low levels of education suffered the most. Tourism states suffered the most, while many parts of America have lost very few jobs. Now, with that background, let me jump into my favorite 3 slides of this presentation. This is the one that Kavitha has been waiting for, the big aha moment. The biggest thing holding investors back today, as you have your conversations with investors, right? They're saying, no, I don't want to commit. The biggest reason is they cannot reconcile the suffering of tens of millions of investors with these skyrocketing stock and real estate prices. So millions of these investors, your investors, are on the sidelines because they keep thinking that something is hugely wrong with the economy and there's a crash coming. And yours truly, me, was one of those people. I sat by the sidelines for months thinking that massive unemployment does not go together with booming markets. And then I decided to investigate. And this is what I found from credible sources like the New York Times. The first bar on the left showed how much the economy gained or lost in terms of wages. You will be shocked to learn that the economy only lost $43 billion in wages in the first 9 months of the pandemic. Why? Because income inequality in the US economy is so high that people who have low paying service jobs are only a very tiny fraction of the economy in terms of raw dollars, right? But still 43 billion, but there were gains. Take a look at this particular bar, right? The second bar shows the unemployment benefit that came from the CARES Act. These benefits were 25 times higher than the same period in 2019. I say again, 25 times higher. A total of $499 billion were added into the US economy just through the unemployment clause of the CARES Act. And that doesn't even include the stimulus checks, right? So $276 billion in the pockets of Americans. Income from businesses, the IRS calls it proprietor's income. Everyone here is thinking, oh my God, that must have gone down a half a trillion. No, it didn't. It went up 29 billion. A lot of that was because of free gifts like PPP and EIDL and all these loans, blah, blah, blah. But income went up, not down in the first 9 months. And then the government gifted $265 billion to hospitals and cities and states, and that was 265 billion. As a result of that, and this is shocking, there was, compared to the same period in 2019, Americans actually had $1 trillion more in disposable income. And I wish I could say that the trillion went to the people that were in tremendous pain, but we know that's not true. A lot of it went into the pockets of those who didn't need it, people like me. But hey, it's money. And those who had more spent more, especially on big ticket items like Teslas and stocks and real estate and Bitcoin. So now you're beginning to understand why real estate and stocks are booming, but income's only one half of the story. What about the spending? Let me be blunt. COVID scared the shit out of people. And when people are scared, they spend less. So here you can see right here, they spend $60 billion more on work chairs and gym equipment and monitors and webcams. They also spent $39 billion more on food and alcohol. But they saved an enormous amount of money on services. All that saved money from haircuts, restaurants, flights, concert tickets added up to a staggering 575 billion in savings versus the same period in 2019. They also saved $59 billion in interest payments from these ultra low interest rates. Thank you, Federal Reserve. Bottom line, Americans spent a total of $535 billion less than they did in the same time frame in 2019. Who would have thunk it? In summary, this combo of $1 trillion in higher income and $535 in lower spending pushed Americans' savings rate through the roof. From March through November, America's savings were a staggering $1.5 trillion higher than in 2019, a rise of 173%. Normally, the savings rate, it stays kind of in a narrow range, around 7% before the pandemic. It spiked to 33.7% in April. That's its highest level ever. So even as millions and millions of people faced incredible financial hardship and were going hungry, Americans in the aggregate, 330 million together, were building savings at a shocking rate. And the savings, it all had to go somewhere. But where? Money under the mattress. That was one option, right? And sure enough, currency in circulation has spiked by 260 billion. Deposits in commercial banks also way up by 19%. But for those of us a little more comfortable with risk, there was investing in stocks. And that is why, ladies and gentlemen, we have this insane increase in the stock market. Only it's not insane. It makes sense now. Plus, Americans fell in love again with home ownership because they were stuck at their homes. So home sales surged massively, and you'll see more on that in a few minutes. Bottom line, $1.5 trillion in extra savings created a tide which lifted the values of all financial assets. All right, let me take a breather. If you get nothing else from this webinar, at least you've solved the mystery of these crazy stock prices and real estate prices. They definitely make sense. Moving on. Flashbacks over, time to look forward. Let's talk about the recovery and what it could look like in two different scenarios. So as we've seen, the money that the politicians threw at the virus, it had a huge impact on savings. So it comes as no surprise that our recovery is also heavily dependent on the size of the upcoming Democrat stimulus package. The impact of the April COVID bill is now fading, unemployment's rising again. The new unemployment benefits that the Trump administration passed in December are smaller, and they basically run out in March. So it's critical that we get another package coming. And so if this package is significant, let's say $1 trillion or more, I can say with a very high degree of confidence that America is going to return to growth very quickly. But if there's no package or a very small package, then we could see a double dip recession. The second item that controls the recovery, timing and effectiveness of vaccine distribution. On that front, the first 30 days were terrible. The government botched the rollout. So now we're hoping that we can correct that. And the last 15 days have been terrific. And we hope they can keep boosting the rollout so we can make that headway to herd immunity. So our guidance to you as investors is that if there's a mid-sized package, let's say $1 trillion, and a critical mass of Americans get the vaccine by June 2021, let's say 150 million people, and we're on track for that, by the way. Our current run rate is 40 million a month, right? So we're on track. Then the economic outlook is looking more and more promising, and most real estate will perform well, with industrial, single family, and multifamily being the strongest, and hotels and retail being the slowest to recover. Vacation markets will take the longest to recover. All right, that's economic trends. And before we get on to mega trends, I want to share some important stuff like GDP growth, unemployment, interest rates, stuff that real estate investors care a lot about, so you need to care a lot about. GDP. We all know that GDP, or simply economic growth, is necessary for home prices and rents to go up. So I am delighted to see that the consensus forecast for 2021 GDP growth are the highest they have been for decades. Typical consensus forecasts have been in the 1.5% range for the last 10 years. So it's fabulous to see a number as high as 3.56. Of course, a lot of this makes up for this negative growth right here. But hey, this is behind us. So I'm happy to take the rebound in 2021 and 2022. Insert smiley face. But there's no such thing as something for nothing. When GDP growth goes up, so does that nasty hydra called inflation. In 2020, inflation was super muted, no challenges, right around 1.25%. In 2021, the consensus forecast is for inflation to go above 2%. Now, for us landlords, sorry, I need some water. Sorry, guys, too much Indian chili. Where were we? So for us landlords, a little bit beyond 2%, that's not bad. Everything gets more expensive, salaries go up, rents go up. So not a bad scenario. As long as inflation stays under 3%, real estate investors are actually pretty happy. So I don't see an issue here. The third big trend indicator that real estate investors watch is unemployment. 2020, of course, was completely off the charts, but 2021 should be a more reasonable number. Now, let me be blunt, okay? 6% is a higher rate of unemployment than anything we've had in the last 7 years. And it's absolutely going to be a drag on wages, drag on investments, and a drag on rents. That's why I'm not bullish on multifamily rent increases in 2021. This is why getting another stimulus package out also is the key to hitting that 3.5% GDP projection. It's achievable, but we need a stimulus package. Our last key economic indicator, the direction of interest rates. So you know, the Fed cut its interest rates. They call it the Fed funds rate. You see it here, right? They cut it to 0. And then they did something super unusual. As far as I know, the Federal Reserve has never offered long-term guidance on interest rates. But the pandemic was so potentially devastating that they made an exception. They let the markets know that they're going to keep rates low for years. As a result, we've had the lowest mortgage rates in history for many months. Today, it's at 2.99%. And here's what the big dogs are saying. The one on the left in green, that's the rate today. I just showed it to you. There are 6 agencies in the US that predict rates. And their average of where rates will be a year from now is delightful. Their average is 3.03. So basically the consensus is rates are going to stay at a 3% average for the whole year. And this is absolutely fantastic news for real estate investors. At 3%, investors can afford a lot more home, and they have room then for rents to go up because lots of people will be buying single-family homes and creating shortages there. So those are the trends for our top 4 key economic indicators, and they look pretty good. So I'm feeling good about it. But now let's look at something much more fun and interesting. The disruption in America's migratory patterns. Let's find out what happened when Americans moved during the pandemic? Well, as you can see, it wasn't good news for America's gateway metros. San Francisco, New York, Los Angeles, Chicago all lost population to their suburbs. And where there are losers, there are winners. The Big Apple had negative rent growth because people were going to Newark, New Jersey. Denver lost people and rental profits to Colorado Springs. Seattle lost people to Spokane. California was interesting in that it had a super cluster of losing cities. San Fran, San Jose, Oakland, Los Angeles, all were in the losing teams for rents. Fresno, Sacramento, and Bakersfield were the winners. Bakersfield. Really, people? Really? So it's fair to declare that the decade-long urbanization trend is over. As you can see, urban rent growth in the US is now negative, whereas suburban rent growth is still positive. People want more space, and the restaurants and the museums just not as important as home offices and backyards. And so people are not just moving from San Francisco and New York to their suburbs, they're leaving the metros altogether. The states in green are seeing huge inbound moves. We invest in Idaho, with which its incredible growth was number one, no surprise. We also invest in South Carolina, which came in at number two. Oregon, South Dakota, Arizona, Tennessee, North Carolina, Florida. These were all big winners in the pandemic super migrations. The states in light blue had some inbound migration. Some people moved in, slightly less people moved out. Texas, Utah, Washington are in this group. The states in dark pink, they're the big losers. California, New York, Illinois, all hit very hard, but most of the Northeast states, they lost a bunch of people. Doesn't look good for you, Connecticut. I think there's only 9 people left in Connecticut. Okay, so that was states. What about cities? Well, predictably, the big loser was the Big Apple with 5x the losses compared to 2019. Chicago, San Francisco, and Los Angeles also lost a lot of people. Surprisingly, San Diego and Seattle bucked that trend. I'm thinking it had to do with technology, but not sure. I'm happy to say we do not invest in any of these 5 big loser markets because sweet Jesus, did that hurt when it came to real estate rents. The green chart on the left shows 1-bedroom rents in big metros before COVID. The orange chart on the right shows the drop in rents after COVID. Take a look at San Francisco. Ouch, double ouch. Remember that rent losses in the great financial crisis were 2 to 3%. And here we are at 24%. Do keep in mind that nationwide rents for 1-bedrooms didn't go down during COVID, right? They went up. So it was really the big gateway metros that got their butts royally kicked. Another trend to point out, 2-bedroom rents are very strong. People want more space, so 1-bedrooms are basically going out of fashion. So I'm really glad that a vast majority of our 2,000 units are 2 and 3-bedroom units. Okay, so those cities were hurt badly. What cities were the winners? Well, I'm going to gloat here. I'm happy to say that 6 of the biggest gainers are markets that we are invested in. Though our analytics, we saw those trends before COVID because the virus didn't start these trends. It just massively, ridiculously accelerated them, right? Other areas of notes that gained population were Austin, Dallas, and surprisingly, a number of slow-moving Midwest markets, Indy, Kansas City, Omaha, Tulsa. These are markets that typically are not considered superstar markets, but they all gained population. The Midwest is seeing somewhat of a comeback, so very interesting. And all those people moving, it shows up in the rent data that I collect. Predictably, vacancy rates in downtowns throughout the US this spiked, sorry, so no surprise there. You see that spike in blue on the right here, right? And it wasn't just vacancy. That vacancy varied by class. Newer Class A properties were hard hit with vacancy spiking, not hugely, but spiking to 5.5%. B and C didn't see much of an impact in occupancy. Now they saw other impacts, right? So it wasn't all good for B and C, but their occupancy was good. And it wasn't just the vacancies, rents also fluctuated. Take a look at the difference in rent growth between suburbs and then the urban areas, right? So I'm happy to say 100% of our properties in the suburbs. So our markets saw rent increases, while urban markets were either flat or negative on rent growth. Overall, looking at all kinds of properties, Everywhere in the whole country, rents did drop a bit. I see on Facebook people saying rents haven't dropped for multifamily. That's obviously not data driven. Rents dropped. They dropped by about 1%. But it's nothing compared. I wanted to contrast it. It's nothing compared to 2008. Take a look here, right? So that recession hit real estate much, much harder than a 1% drop, which seems to have disappeared in the last month or so. In fact, if you leave out more expensive Class A units, it's fair to say that rents in workforce housing for common people in the US didn't really decline much at all, right? Less than 1%, as you can see here. And just like vacancy, rent growth varied a lot. Here you can see how different markets fared, right? So, take a look at your favorite markets, right? The markets we invest in are in green, right? So one of our markets, Houston, it saw a really tiny drop, but the other four markets saw a big increase. With the market that has our biggest project, 55 million, Phoenix, seeing a huge increase in rents. Insert another smiley face. What about sales price per unit? Well, we saw a teeny tiny dip in prices, a couple $1,000s per unit right here. You can see it here. I'm happy to report this data doesn't go all the way through Jan. I'm happy to report that dip has now ended. And in Jan 2021, we're right about here. See where the red cursor is? And so we are again at an all-time high price for apartment price per unit. So somewhere in the 180, 181 range at this point of time. And as a result, every one of you who understands cap rates knows, well, that means cap rates must have gone down or stayed stable. Well, they haven't gone down, but they are absolutely stable. Now, something I want to tell you that might be exciting for all of this gang in here, because most of you guys are apartment people, is that 8 out of the 10 analytics groups that I read reports of, people like CBRE and Berkadia and Marcus and Millichap, 8 out of 10 are projecting a compression in cap rates in multifamily in the US. So good news for you guys. Compression again. As you can see, the compression started right here, late 2009. And since then, it's been a wonderful story of compression. We were flattening out before COVID, and now it looks like we're going to go down again, but maybe not immediately. But rents and vacancy all don't matter if you don't collect the rents, right? With governments preventing evictions, we were all worried about rent collections. And we saw the best case scenario in my mind, right? 94.7% of renters are paying rents. This shows 2009 collection, 2019 collection. This shows 2020, sort of look the same. So only 1.5 percentage point off last year. Now, I want to point something out. So I see a lot of nonsense on Facebook about Class C doing better than Class A and Class B when it came to rent collections. That's just wrong. People are just putting out crap. There's absolutely no doubt that when it came to delinquencies, Class C was the hardest hit. It didn't lose any occupancy. In fact, we are seeing in strong markets occupancy go up 1% in Class C properties, but they definitely suffered the most in terms of delinquencies. Every market that I've looked at, every major market, Dallas, Atlanta, doesn't really matter. They've all seen significant delinquency. So people, stop spreading misinformation. All right, that was a lot of information on apartments. I know you guys are apartment people, but I also own 10 single family homes. And it's super important to understand the single family rental market. One thing I never get with apartment people is they don't understand that their fate is always tied to single family, right? Because if single family doesn't do well, apartments very rarely do well. And our single family story starts with foreclosures. In 2010, here on the left, nearly 3 million homes in the US went into foreclosure. So lots of supply for new homeowners, for landlords like me. I bought 10 of them. But by 2019, the year before COVID, that 3 million had gone to 500,000. So effectively, very few foreclosures, right? So there's nothing happening. There's no supply of foreclosures today. Now, 2020, of course, has very few foreclosures because the government banned them. In 2021, we do expect them to tick up a bit. But all of you here that are expecting a tsunami of foreclosures, I see that word on social media, you're going to be sorely disappointed. You know why? Because unlike 2010, 97% of homes today have equity in them. Only 3% are upside down. This means that when push comes to shove, they're going to choose to sell rather than a bank foreclose on them and ruin their credit. So if you're waiting for foreclosure, good luck to you. You're going to be waiting for a long time. Another reason why there's so much single family demand is the rental market. One surprising megatrend is that more affluent renters are turning to rentals like single family townhomes and very upscale apartments. In fact, look at this graph. Since 2012, the percentage of renters making more than $100,000 has gone from 8% to 13% of the rental market. And most of these renters, they're not investing in apartments. They're investing in townhomes or single family homes. So that single family market is seeing a lot of interest from people who want to buy and also from people who want to be landlords. And then the renter demographic in the US is changing. 20 years ago, most renters were young singles. Today, things have changed. Take a look. Young families are renting more. Middle-aged families are renting more. Mature families are renting more. Multi-generational families are living together in larger single-family homes. And look at the spike in single-parent rentals. All of these groups prefer to rent townhomes or single family rentals over apartments. So as we move from young single renters to family renters, there's lots of demand for townhome and single family rentals. Lots of upward pressure. Keep that in mind. Another group creating demands are the empty nesters. Instead of downsizing to a smaller house or smaller home as previous generations did, they're selling their homes and they're using that equity to finance their lives, and they're going out and renting smaller single family homes. More upward pressure. And all this upward pressure is raising single family home prices in the US much faster than wages. As the median sales price, shown in red, continues to rise, the home price to income ratio is also rising because incomes are simply not keeping up with prices. And as this ratio goes up, more and more renters are being created. Here's the good news for you, you multifamily people, and I count myself among you. So as this ratio is going up, more and more renters are being created because they can't afford to buy a home. In fact, today, 50% of renters say they cannot afford the down payment. 30% they say they cannot qualify for a mortgage. And you might think, yeah, the single family market, the builders are going to flood it, right? No, that's complete BS. The builders are not sitting idle. They are building and selling a lot more homes. This graph shows that except for March and April, the first 2 months of the pandemic, builders in the US sold more single family homes than 2019 in every month. In fact, look at August, September, October, they're selling 300,000 more homes each month than in 2019 in the middle of a pandemic. The lack of land, the lack of labor, and ridiculously high lumber prices in the US mean that builders cannot build more. They've already boosted supply. You can see it's already plateaued. There's just no land and no lumber to build more. And that is why, ladies and gentlemen, it's no surprise to me that Realtor.com is projecting a 5.7% increase in single family prices with a seller friendly market in 2021. The chief economist at Redfin says that the number of sales for single family in 2021 will be so high, they'll be the highest for any year since 2006. And the usually very bearish and conservative, Grinches at Zillow, they're shockingly bullish. They're forecasting almost a 22% sales growth over 2020. That would make 2021 the biggest one-year gain in sales since the early 1980s. Wow, Zillow, you're really hanging it out there, right? And if you're actually right, I might be buying my own jet in a year, because as you guys might know, I build clusters of single family townhomes. Anyway, with the giant jumps in sales volume come big jumps in prices. Realtor.com really hit it on the head. Their forecast of a 5.7% increase in home prices here in green exactly matched the consensus, the average forecast from the top 5 forecasters, right? For my own sake, I hope all of these guys are wrong and these dudes are right. Look at this skyscraper, 10% in a single year. Wow, right? And keep in mind, this 5.7% consensus, this is the whole country. That means that fast growing parts of the country, like Phoenix or anything in Idaho, they're going to see double this number. And slow growing parts could see half that number. Still, 3% is a good year. Bottom line, you can't ignore the single family market. It's going to be a rock star market in 2021. Super low interest rates, massive renter demand, lack of supply, all add up to trillions in new homeowners equity and very fast rising prices. I have not been this bullish in years about the single family market. All right, now on to the most popular section of this presentation, the best cities shootout, especially the best small cities. And before we do that, though, I want to show you the kind of projects that I'm building. I've been planning these and building these projects for the last 2 years, and now I can really take advantage of these trends, especially those single family trends that I just showed you. So what I'm doing is that I'm building turnkey fourplexes in the top markets in the US. What are the top markets in the US? Well, fastest growing state in the US, Idaho, and fastest growing state in the last 10 years, Texas, right? So we're building them in those states. They're fourplexes, investors buy them, and they get benefits that syndication can never even dream of. The biggest challenge with syndication is you give them depreciation, and then you sell 2 years later and you recapture all the depreciation. And that makes investors grumpy. But here, you buy this sucker, you refinance out of in 5 years, take all of your cash out. You have infinite income. You never sell these things. You keep them for 30 years. You have 30 years of depreciation. And then when you die, the basis adjusts and your kids never pay for the $3 or $4 million of equity you create in 30 years. I found these for myself personally to be the best driver of generational wealth. Syndications are awesome. We all love them. 80% of my business is syndication. But no syndication creates generational wealth. It's impossible for them to create generational wealth. And we love multifamily, but I find that the fourplex is actually the best of both worlds. I don't have to deal with these nasty multifamily lenders that we are all very aware of, especially today when they're being especially nasty with all these impounds. I can basically get 2.75% interest rates. I can get 30-year locks, no defeasance, no loan penalties. Basically can sell them at any point in time. I can sell them to 1031 investors that pay 3 cap, and I can even do house hacking and pay 3% down. All of those benefits only come from fourplexes. Sure, you can buy older fourplexes at 4.5 cap, but then they have roofing costs and foundation issues. So I decided to build new ones for myself, for me. I was being greedy, but once I started building them, I realized I could build them for myself and for other people. I build them in Texas. I don't think anybody here needs this slide. So I'll just point out to the fact that those of you in California, we just lost HP, Tesla, Oracle, and CBRE to Texas in the last 60 days. Digest that for a second. And in Texas, I like Houston. Why? Because it is the top US metro for job growth. It's the second fastest growing city in America. And its growth is coming from healthcare. The Texas Medical Center is the largest medical center on earth. In fact, their oil industry is shrinking, but doing okay. You saw this jump, and you saw oil come back very quickly. But really, a lot of the growth is coming from healthcare. It is the fourth largest population in the United States, and it's poised to recover very quickly. So what we build there is we're building clusters of townhomes. This one, for example, is 14 fourplexes. Investors buy that from us, no splits, no fees, everything. They just keep 100% of the profits, and they don't pay us a dime of fees. And they enjoy these kinds of amenities for their tenants. We lease them up for them and hand it to them fully leased. So there are 14 of these, but we only sell 7, and the rest will be kept for later and for ourselves. So if you're interested, I'm happy to talk with you about these. This group, these are about 1.4 million. So their down payment is about $436,000. But keep in mind, the reason people buy these is not their sexy cash flow. They buy them because of this chart on the right here. See this chart? This is wealth. You're going to start off with $1 million mortgage and $400,000 in down payment. The mortgage will go down over time. The principal will go down. Your equity will get built. 30 years later, you'll be sitting on $4 million, and you'll have 27 years of depreciation along the way. And when you die, your kids will get the basis moved up to this 4 million point, and nobody will ever pay taxes. That's what I found to be better than everything else that I've ever done in my career. And that's what they look like, by the way. For those that want them cheaper, I also build them in the fastest growing state in the US and in the fastest growing city in the US, Idaho Falls. These are about $960,000, so they're a lot cheaper, about $250,000 down payment. They're also delivered much faster, so they're going to be delivered in Feb next year. We're building them now. Why? Because Idaho Falls has the fastest job growth in the US in the middle of the pandemic. Look at these home price growths, 11% in 1 year, 26% in the last 2 years, 66% in the last 5 years for home price growth. And Idaho Falls happens to be the only city in America with negative vacancy rate. That's right. The vacancy rate for rentals in Idaho Falls is under 0%. And as a result, and the reason why it's under 0% is Idaho Falls was the only city in America to have positive job growth in 2020. Out of thousands of cities, there are two, actually there's two, Idaho Falls and Logan, Utah, that actually saw job growth in 2020. And so Idaho Falls unemployment rate fell during the pandemic to 3.6%. All right, end of sales pitch. If you're interested in those fourplexes, please let me know. I'll ask Kavitha to put my information in, and I'll send you some links. If these seem interested, please contact us. I can pretty much guarantee it. You're going to make more money in the long run. So Kavitha, I'm going to finish with the best cities. I've got about a minute left, or actually maybe like 3 minutes left. We got 3 minutes?
No, we should be okay. People will stay
Okay.
on because this is a lot of great information. So I'm not too
Awesome.
worried. If you have time,
All
we
right.
have time.
Awesome. So I'm going to give you the top markets for single family first and then do multifamily. So there's a couple slides of single family and a couple slides of multifamily. No surprise here. Idaho is a red hot economy. In fact, Local Market Monitor ranks the top 4 markets in Idaho to be the top 4 markets in America. But Zillow only picked Boise because Idaho Falls is too small. It has to be, it's under 250,000 people. Boise at number 1, Tacoma, Washington, benefiting from the Seattle halo. And at number 4, Spokane, also benefiting from the Seattle halo. Seattle itself comes in at number 7. A lot of growth there is being driven by Amazon and all the stuff that they're doing and Microsoft. But for me, if there's a nugget in this presentation, it's right here. It's a completely unknown city called Killeen, Texas. Killeen.
I would have never thought.
Why is the city in the middle of nowhere so special? Well, if you live in California, you know that Sacramento has been the most profitable city in California in the last 5 years. All those Bay Area people that ran away went to Sacramento, they exploded the rents, they exploded the prices. Now apply that example to the new Bay Area, to the new Silicon Valley, the powerhouse that is Austin, Texas. Tesla's moving there, Oracle's moving there, and Austin's red hot. It's super expensive though, right? But 67 miles away is a very nice little city called Killeen. You can buy a median home in Austin for $437,000, or you can buy a median home in Killeen for $146,000. I do not recommend Austin to anyone for value-add multifamily. It's super expensive. But take a look at Killeen, 1/3 of the price of Austin. And as Austin continues its multi-decade rise, all ships will rise with the greatest real estate effect in America, the Austin effect. If you don't like Killeen, if it's too far for you, take a look at 2 other cities. San Marcos is 31 miles from Austin, and better than San Marcos is New Braunfels, 48 miles away. Those are phenomenal because the Austin-San Antonio corridor is the most important real estate corridor in America. So take a look at those. And if you don't like any of those, take a look at some of these other cities. Cleveland, Indianapolis, right? I want to see more population growth here in Cleveland before I recommend it. But Indy is seeing very rapid growth in population. So check out Indy, lots of potential. I don't like these last two, so I'm not going to talk about them. Realtor.com, they've also got a top 10 list. They project that San Jose, California is going to take this top spot. I'm not sure I agree, but Seattle at number 2, I agree with that. Boise, Idaho, one more time, right? America's newest tech hub. Sacramento makes so much sense. It's cheaper than the Bay Area. Phoenix shows up in every list on the planet, right? So that's never any surprise. 2 less expensive cities in California, so that makes sense. 8 and at 8 and 9 are 2 superstar cities, Denver and Charlotte. They're doing really, really well. I don't know anything about Harrisburg, Pennsylvania, so I'm going to skip that one. Okay, multifamily. Well, I'm finishing off with that. The top 2 are simply the cheapest market in California. So no surprises there, right? Phoenix is a powerhouse at number 4. Indy shows up again at number 5. Atlanta is ever present in these lists, so still a phenomenal metro. And then there's 2 powerhouse metros in North Carolina, Charlotte and Raleigh. They were my top picks for cities last year. It's also nice to see Kansas City in this list. We're beginning to see more Midwest. Growth is moving. Did you notice the absence of Texan markets? Texas is clearly the most powerful economy in America, but nothing stays great forever. All right, that was Yardi Matrix, right? So I cross-checked the list with CBRE's list. Actually, it was very similar. Phoenix, Tampa, Atlanta, Kansas City, Indianapolis, Raleigh, all repeated. But the one city that I saw in this list that I didn't see in the other one was Jacksonville. So keep that in mind, that CBRE thinks Jacksonville is a great market. All of the others that I mentioned were pretty much repeats in both lists. All right. So those were the top cities in America for 2021. I'm going to end with my picks. Just to remind you, my picks for best city in America in 2016, 17, and 18 were Provo, Utah, Boise, Idaho. And then last year, I had a tie with Raleigh and Charlotte as my top joint pick and San Antonio as my dark horse pick. All right, here's my up and coming market, the underperforming market, and this is my first ever pick in the Midwest. While crime remains a concern, Indianapolis has a fast growing population and income growth. Home prices are going up and up. I am very unlikely to invest in Indy, but I do think this market is underpriced. It offers some serious bargains for investors. Just steer clear of the high crime parts of Indianapolis. And to finish off, drum roll, my pick for best city in the US for real estate is Phoenix, Arizona. After narrowly missing out for 3 consecutive years, it's been in second position 3 consecutive years. I'm delighted to call it my top pick. The fastest growing large city in America. It's got so much going for it that COVID had almost no impact on it. And I expect that Phoenix, despite being red hot, almost too hot, is going to continue to fly in the coming year. I don't recommend anyone invest in Phoenix, but Phoenix Metro has some great bargains. If you're looking for one pick inside the Phoenix Metro, I would unquestionably pick Mesa. Mesa is the second largest metro in the Phoenix area, and from what I can see, it's very likely to go on because it's cheaper than Phoenix, but the quality of the people that live there is very high. So check out Mesa as a potential investment area. And that's our show, folks. Hope you liked it. We do about 20 of these webinars on Multifamily University. So if you're not signed up in our list, please check these out. My next one is a 2-hour webinar in 2 parts on the devastating impact of climate change on real estate and how it's going to affect the state of Florida. So that comes out in a few weeks. We've already had a lot of interest in that webinar. We've been telling people about it. So if you haven't signed up at Multifamily University, please do. And if you're interested in learning about our fourplexes, the no-fee fourplexes, plug that into the Q&A. I'm happy to grab your information from Kavitha. Awesome.
I'm just catching my breath.
Is your brain hurting yet?
Oh my God. I'm glad this is being recorded because I need to go back and watch it. It was a ton of information. So I'm sure the audience, I've been getting messages saying, oh my God, this is great. So
I like to cram it all in, and somebody told me a long time ago, if you're on a slide for more than 20 seconds, you're doing the wrong thing. So I was like, I'm never going to be on a slide for more than 20 seconds, except for that COVID one. Wasn't that interesting? The $1.5 trillion. So I spent a little more time on that, but the rest were just like, touch, all leading up to kind of the conclusions.
I mean, that really made sense about why there's so much money in the stock market. That was just, everybody was baffled with that idea. Like, why is there so much money in the market? It makes no sense.
Well, then go tell your investors that, right? I mean, 2/3 of the audience here are raising money for their projects, right? Steal that slide, right? You want a PDF? Have at it. Take that slide, show it to your investors, get them off the sidelines.
Right, right. Because a lot of people are like, hey, I don't know, maybe everything's really inflated. So this is really insightful. So thank you so much. Please ask your questions if you have any.
Yep.
I know everybody's probably overwhelmed. I'll definitely have
I
to.
know it takes a little bit of time to get people started. So I usually basically start them with cities. So if you have a particular city that you'd like to ask me about, go for it. And I'm going to answer this one question. Are you buying the land and building the fourplex yourself with other builders? I'm the developer. There's nobody else involved, but I manage the builder. So I basically hire a local builder and I signed a GMP or guaranteed maximum price contract. And I provide the architectural designs and they build it to suit, build it to spec. So they really don't have much room for growth. I don't let the builder decide anything. I decide every doorknob and every, French drain. So we have templates and we basically fit them on pieces of land. So they really don't have much room to change things around.
That's
All right.
awesome. Definitely, if you guys are interested, please reach out to Neal. It's Neal at growcapitalist.com,
That's right. You can see it
or
on
just go to
screen.
growcapitalist.com. You'll reach him.
Yep.
Let's get through some questions. Neal, what surprised me was Killeen. I've lived in Austin for 21 years, right? I
Yep.
really know this market. The interesting thing about Killeen has been it's been a very rough market in terms of tenant base. So
Yeah.
I will ask
Absolutely.
you the first question, like, what do you think? Because it's primarily been a military tenant base, which, as you know, they can walk away from leases. And the other thing which kept me out of Phoenix market, I mean, clean market for a long time, was the fact that the tenant base was essentially low income, very rough. So it
Very
still
rough.
presents an opportunity in terms of pricing, but my concern would be the quality of the tenants.
Absolutely. Right. So I'm glad you asked this question. Right. So the the truth is this: opportunity, if you want big time opportunity, it's always going to come with some risk. Let me give, there's a lot of people on this webinar that are from the San Francisco Bay Area, right? How many of you wish that you had invested in East Palo Alto 5 years ago, right? It was the fastest growing market in the Bay Area, but isn't it also the highest crime market in the Bay Area, right? Still, there's nobody on this webinar that lives in San Francisco that wouldn't kill to invest in East Palo Alto. Here's another market for San Francisco Bay Area people, Vallejo. It is known as a high crime market. It was the second fastest growing market in the US. The bottom line is this: when growth happens, the nearest market that is low income and high crime, people get pushed out. Oakland, California, people got pushed out. Oakland's crime fell. People moved out to Hayward, right? And the rents in Oakland doubled. Point is, this happens everywhere. The nearest high crime, low income market, those people unfortunately will get moved out. And it's sad because they had all these cheap homes. And in 5 years, all those cheap homes are going to be gone and Clean won't have any, right? So when you start there, you're going to deal with a problematic tenant base. But the kind of growth that you see there is a growth that you cannot get in Austin. In fact, you can't get it in any major city, right? So there, with the risk comes the benefits of the Austin effect. So you asked me before anyone joined this webinar, right, about Austin. So obviously it's the greatest market in America, right? Everybody knows this. But you can't benefit by going to Austin. You have to take a risk. And there's two, if you want less risk, you have 39 miles away New Braunfels. Take that one. If you
Yeah.
want more risk and you want more profit, go 67 miles to Killeen. Absolutely, markets change. Remember this, that if it changes, it's too late for you, Kavitha.
Yeah, I
You
agree.
have to go before it changes,
I agree.
right?
Yeah, I've been telling
Mark, you are correct, right? That is gentrification. And gentrification is a pretty awful thing that happens when poor people get pushed out. But you're not a politician, Mark. I'm not a politician. They're in charge of preventing gentrification. They're doing an awful job. And if it's going to happen anyway, why don't you have your investors benefit from it?
I agree. 100%. That makes a lot of sense because even in Austin, Neal, before all this growth happened in the last 10 years, the east side of Austin, nobody wanted to live in. It was high crime.
Yep.
That has gentrified so much that it's insane. It's so close to
You
downtown.
can't even tell that this was a part of Austin. I mean, nobody wanted to live in these areas in Austin, right? And now homes sell in one day. right? A single day. The home comes on the market and that same afternoon somebody buys it, and they often buy it all cash. The point is, there's nothing left at all in Austin, and the only city within driving distance is Killeen.
Yeah, and San Marcos and New Braunfels, like you
San
pointed
Marcos is
out.
expensive, right? I mean, it's hard to kind of compare San Marcos with the prices in Killeen,
True, true.
right? So San Marcos average home price is more than 2 times Killeen's price.
San
So
Antonio is still affordable, although it is a drive. It's an hour from Austin, but I think eventually that whole
the metros will merge. Those two metros are going to become like Washington, Baltimore. Basically, just becomes one long strip of people, right? And the metros will merge. The city that's going to benefit the most is New Braunfels because it's in the middle, right? That city is commutable to both super metros. So I think the long bet is New Braunfels. Just so you know, I'm not going to Killeen because it's too small for me, but I'm building a massive project in New Braunfels, massive. So
Yeah.
because I'm patient, I mean, I can wait for my profits to come. So I'll take a few questions that are interesting to me. Are the fourplex modular homes? No, I do not believe America's cracked the modular code. I just build what is known as stick construction, which is very cheap, very fast. You provide bridge financing or property management on the fourplexes? Yes and yes. Let's see. I'm going to move on to some more questions. Maybe
What are
not
the
fourplexes.
emerging markets now for multifamily? Ajit asked.
So there are a few interesting ones. If you want a very early market, it's Omaha, Nebraska. So I have trackers where I have early indicator trackers and I have very early indicator trackers. The one that I think syndication gurus are going to start talking about in about a year is Omaha, Nebraska. So pick that one. And then there's some that people have known about for a while. Huntsville, Alabama, I still think is a phenomenal market. Greenville, South Carolina is going to become a syndicator market over the next year. I think that's a terrific market. It has absolutely phenomenal fundamentals. So check out Greenville, South Carolina. South Carolina is benefiting from the North Carolina halo effect. Charlotte, Raleigh are superstar markets. And so that market is really benefiting. So check out Greenville, South Carolina. If you want super small markets that nobody else knows about, Sebring, Florida, Sebring. Sebring is 30 miles south of Lakeland. It's inside the corridor that goes from Orlando to Tampa. That's Freeway 4. So you go halfway from Orlando to Tampa, and then you turn south, and you end up in a city called Sebring. That's a small one that you should look at if you like Florida. And then if you like Utah, Logan. Logan's incredible. It is the only other city in America that gained jobs in 2020. So if you don't want to go to Idaho Falls, or if it's too far for you and you live in Utah, take a look at Logan. It's absolutely phenomenal. Let's see.
Hey Neil, I want to pick this. Would the stock market crash if COVID goes away by inverse logic?
No, I don't think so. I think that the money that was injected into the US economy was gifts to people, gifts to businesses. They gave us PPP, they gave us EIDL. Where's the contract to take the money back? It's a one way, right? That money is already out. The stock market's there because that money was there. As I mentioned to you, out of the 1.5 trillion, 260 billion is being held by Americans in currencies. Some of that is going to get invested in the future, right? The rest of it's gone into the markets. And I think that the fact that the markets have gone up has created a wealth effect. Just the stock market created $1 trillion of profits just in the last 5 months, or 6 months, I'd say 6 months. So that's additional money. So no, I don't think the stock market crashes because COVID goes away. I think the stock market crashes if they don't do another stimulus bill. I don't think it crashes, but I think it's going to decline.
Or the stimulus is not as big, you said.
I'd say $1 trillion is achievable. If you remember, Republicans offered 618 billion yesterday, and Biden turned them down. So I think it's going to be bigger than 618 billion. All right, let's see. Are we able to pay quarterly dividends to all investors on time at this pandemic time, or having any issues? Of course, we're having issues, Kali. I mean, even on properties that we can pay, we've reduced our dividends to just to get our operating, funds up. I honestly, if you're a syndication investor, you shouldn't be focused on your dividends in the middle of a pandemic. I think you should be focused on how the property is being managed. If your syndicator is managing it well, then be happy. If you're the syndicator and your property is not having significant delinquency, be happy. The investors will stay on with you. Just so you know, they know that there's this thing called COVID out there. I don't think you're going to lose one investor. All right, let me see, going up and down. Let's see. All right, go here. Boom, 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 boom. So I'm going to keep going up. Atisha, I like your dream. That's a good dream. Atisha's dream is to build a strip of duplexes and fourplexes on a 2-acre lot. Well, that's what I'm really doing. I'm just building at 5 acres, but I'm doing the exact same thing as you, Atisha. So that's a great dream to have.
Neal, we have 13 questions in the Q&A box.
Okay, all right, let's go take a look at those.
Do you have time to keep going?
Let's see. Best advice to young investor getting started with hopes to construct and hold. I like the duplex, fourplex product for construction. My advice, don't do it in Texas. Doing it in Texas is much harder. Do it in states with small cities. Small cities are very friendly to people who don't know all of the stuff about construction. I'll give you an example that will shock you, right? On a $10 million project, typically you spend $200,000 on architectural. Does that sound about right? Right? 2%, very common. Guess what my bill is for my $10 million project in Idaho Falls? $2,300. Because Idaho Falls does not require architects to sign off. So you can go to a $30 an hour draftsman and have them draw the property for you, and you can submit it and get it approved, right? Go to smaller cities, but not in Texas because your property taxes are high. Texas is not necessarily the best place to build. I'm building there. I like Texas, but it's really for experienced folks. So if I had to pick one, I'd say Idaho is probably the easiest. Florida is also awesome for fourplexes if you're building them for wealth. And again, syndications are awesome, guys. You make lots of money from syndications. Don't ever stop doing them. They just don't build generational wealth. So take the money from your syndications and go build your fourplexes, because by the time you die, your kids will have $4 or $5 million bucks. Let's see. Short-term San Francisco Bay Area still looks strong. What about 2 to 3 years? Well, that depends. I don't think the Bay Area looks strong for multifamily right now. Rents are declining. It looks really bad. Single family in the Bay Area looks strong. I expect it to continue to be strong because the Bay Area has no land left. A place that has no land left is not going to see price declines. What do you think about the build to rent model in single family homes? Build to rent is the single greatest trend to come out of real estate in the last 10 years. I'm doing a webinar on build to rent on Multifamily U in about 3 to 4 weeks. You can come in and I can tell you more about it. Everyone that I know and their mother is getting into build and rent, because the truth is there's no value adds left. Like, have you noticed? I mean, like Kavitha is looking at value adds. She sees an offering memorandum and it's like 80% of the units done, value add. The next one comes in, 70% of the units done, value add, 60% done. I mean, come on, where are the rest? Well, they've already been rehabbed. We've been at it for 10 years and there's like 3,000 indicators, right? So one of the things that people are not getting is there isn't an infinite supply of 1970s and 1980s apartment complexes in the US. I'm not saying the game is up, but I'm saying you guys are fighting over a shrinking population of apartment complexes, and every year the number of syndicators increases by 20%. So guess where the institutional people are going? They're like, okay, we've had it with this value add. We enjoyed ourselves for 8 years, made loads of money. Now we're just going to build these single family homes for rent. And then they're going in and finding single families too expensive. The rents are not working out. So now they're building townhomes, right? So who's doing it? Number one builder in the US, Lennar. They have a fund. Who's doing it? Number 2 builder in the US, Toll Brothers. Who's doing it? BlackRock, the number 1 real estate fund in the world, is doing it. Everyone and their mother are like, okay, value add was great. Now we ran out of value add. What's the next thing? It's built to rent. That's the answer to your question. All right.
Neal, I have a question for you on the fourplexes that you have in Houston and Idaho. Are they on the regular, are they qualified for residential loans or is commercial?
And everybody gets a residential loans. I mean, they're awesome. Right now, it's 2.85, 2.9%, something like that. So you get a residential loan. And if you live in one of the units, some of our investors are actually from San Antonio and Houston. What they do is they go live in one of the units for 2 years. Some of them are getting like 3% down loans at 2.85%. It's just shocking. Like they're buying $1.4 million products for 50 grand down.
Right. But that's not very available for people not on a W-2, right? Self-employed.
Well, depends. It's mostly for W-2 people, yeah. So I think that if you're non-W-2, you're probably better suited for syndications. That's the right venue for you to use as a non-W-2 person. Yeah, I think this is really a W-2 enterprise, very much so. Let's see. Trillions in economic stimulus being injected by the government are largely borrowed. Our national debt is rising quickly. Do you see any long-term impact of this borrowing? Joel, I'm going to give you a completely counterproductive answer, right? So why are people afraid that we will borrow too much? Think about it, right? Only one reason. They're afraid that people will stop buying our debt and buy Japanese debt. They'll buy European Union debt. They'll buy Chinese debt, right? That's why what they're afraid of. So then our bonds will go up, and we won't be able to borrow anymore. Okay. Well, what happened with COVID? It was a crazy world-changing event where all 200 countries in the world printed money at the same time. Well, as a result of that, while our debt to GDP ratio went up, it went up more than ours for most other countries. You see what I mean? And we're the reserve currency of the world. So believe it or not, oddly enough, even though our debt went up, we're in a vastly better situation than we were 12 months ago, because other economies didn't take the aggressive action that we took. Their economies are suffering, right? The US is out of a recession, but most economies in the world today are in a recession. And as a result, their debt to GDP ratios are getting worse than ours. We ended up with an advantage with COVID. COVID actually has given us 5 more years of this ridiculous money printing experiment. So we actually pushed doomsday back 5 years, believe it or not. All right. Doesn't make sense, but if you want to, a math class, I can spend time with you. All right. I'm trying to decide between Tacoma and Spokane for investment. Oh, that's an easy answer. Definitely no on Tacoma. Definitely yes on Spokane. Remember, Spokane is 20 miles away from the most red-hot economy in the US, Idaho. Spokane, definitely Spokane. And cheaper. Spokane's cheaper than Tacoma. All right, so let's see. Any good places in New York to invest? Yes, there's one pretty close by. It's called Florida. Have you heard of it? Florida? All right, do you think self-storage will track with emerging multifamily markets that you highlighted? Yes, I'm a self-storage investor, so I track those markets. They seem to be doing well. I haven't seen any significant issues with the self-storage market. My own properties have done fine. Yeah, I think they track with multifamily. I think that they are. Would you consider a portfolio of 80% multifamily, 20% single family a good one? The answer is no. To start off, 80-20 is a good split. 20 years from now, it should be the other way around. Multifamily is a great way to build cash flow, build investments. But single families, fourplexes are a great way to build wealth. Your job early on is to use the benefits of syndication to put money into your pockets. But in the long run, your job is to leave money to your kids. Well, the way to do that is to have either single family portfolios or build to rent portfolios. So it's a migration process. So you're absolutely right, 80-20. But when you're done, 10 or 20 years from now, 20-80. Let's see, given the flight to suburbs and smaller cities, are Sacramento and Stockton's good for single family rentals? I think so. I think Stockton's probably better at this point. Sacramento's pretty expensive. Let's see. What characteristics analysis would you do to ensure fourplex projects have ROI in an Atlanta suburb? Well, that's really easy. Fourplexes, the analysis is the same as a single family rental. You don't change anything at all. So if single family rental markets, I pay for 2 software. I suggest that you pay for them. A lot of people are like, Neal's pitching some software. I have nothing to do with these software. I just know they're awesome. The first one's called housingalerts.net. And the second one is called localmarketmonitor.com. Just so you know, if you log into national licenses of both, which I pay for, the first 4 markets in the United States for both software are as follows. Number 1, Idaho Falls. Number 2, Pocatello, Idaho. Number 3, Boise, Idaho. Number 4, Twin Falls, Idaho. For both software, these are the top 4 markets in the US. But that wasn't your question. Your question was Atlanta. The good news is you can simply type in every zip code in Atlanta into this software. And one of them, by the way, is a great bargain because it's called Housing Alerts. You can buy it for 199 bucks on a monthly subscription and then unsubscribe the following bucks. Best 199 bucks you'll ever spend because you can plug in every single zip code in Atlanta. It'll give you an investment score, grab it as a PDF, store it on your drive, and go unsubscribe. Awesome, right?
So quick question, Neal. Investor asked, can fourplex be bought using SDIRA? I think that'll be a little
Why not? I mean,
complicated
a lot of people buy, fourplexes with this kind of stuff, solo 401ks, self-directed IRAs. It's actually, we don't know that in multifamily, but more people buy single families using self-directed IRAs than they buy multifamily. So yes, a fourplex is a single family, right? So you can buy it.
But the mortgage, wouldn't that be against the IRA rules where the mortgage will be held in your name and your retire, unless it's all cash? I don't.
Yes, but I'm not going to incriminate myself in a webinar with 100 people watching, but you'll notice that there's lots of people that get around that.
Okay.
So I'll simply say, talk to a self-directed IRA provider. Joshua Tree, California. I don't know anything about Joshua Tree, so I'm going to skip that city. Let's see. Prasad says we're seeing 15 to 20% price increases in single-family suburbs of Seattle for single family. Do you expect prices in single family to come down in 2022? Hell no. I expect Seattle to be one of the top 3 performers for further price increases in the next year. No, you're in the right place, Prasad. Buy something if you can. Let's see. Housing speculators could bring on a repeat crash. I saw that article on Medium, anonymous attendee, but I don't believe it because what they're discounting is the fact that crash was caused because everyone had no equity. We now have about $6 or $7 trillion of additional equity. Come on, COVID couldn't crash the single family market. What are you talking about? I mean, you've just had an incredible display of the resilience of the single family market. And obviously multifamily did well. It didn't do as well as single family, but we obviously have to deal with the renters and the fact that we can't evict anybody. But I think we did pretty well, right? So come on, what crash? What crash are you waiting for, anonymous attendee? Maybe you're somebody that just sits by the sidelines, even though you've just seen an incredible display of resilience. All right.
I have a question here. What are your thoughts on Tucson, Arizona for multifamily over the next 5 years?
I think Tucson's a tremendous market. I always tell people the secondaries are better than the primaries because the primary gets overheated. So, parts of Phoenix are now extremely overheated. Tucson's heated, not overheated. So, and I also find that the ASU expansion that's going on in Tucson is great. So what I would suggest is if you really want to benefit, stay within like a 3-mile radius of ASU in Tucson. I think that area will grow faster than the rest of Tucson. It's also a good market for building. You can build fourplexes, you can do developments in Tucson. I think it's a solid market. It's not a superstar market. I'd probably go to Greenville, South Carolina over Tucson, but I think it probably would be in my top 10. I have properties there and they're doing really well.
I'm going to pick this one, Neal, because a lot of my investors ask me this. They have rental homes in San Jose area. Should they keep it or sell it to invest somewhere else? This comes up quite a bit.
That's a really tough one. I mean, you saw that one of my 2 providers, Realtor.com, ranked San Jose as #1 for their forecasted growth. I think that San Jose is just so unusual, being Silicon Valley. I think that it's possible that if you hold on for one more year, you can get another 10% for your money, but it's not long now. I think you get one more year out of San Jose. So I'd say look to sell a year from now, right? You'd probably buy an existing fourplex anywhere in the US from that money and increase your cash flow. How hard is it to get permits for fourplexes? Well, could be really, really hard if you're in Seattle. Could be really, really easy if you're in Idaho Falls. The answer is depends on the city. Let's see. What are the goals and objectives for the next year? What specific asset classes and markets you're going to focus on? I think that if I haven't made my markets clear by now, Callie, I don't think I'm going to do anything there. But in terms of asset classes, my favorite asset class is not multifamily and hasn't been for 2 years. It's industrial. So we saw 5 years of e-commerce growth in the last 9 months. We saw Amazon become the richest, biggest company on earth. We saw Jeff Bezos lose $40 billion to his wife after divorce, still stay the richest man in the world. How many more indicators do you need? Let's see. When COVID ends, does migration trend change from suburbs to cities? Absolutely not. COVID did not start the migration trend, it accelerated it. Take a look at migration trends for 2017, 18, 19. You'll notice that each year migration trends from cities to suburbs were accelerating. So 3 years before. And then you saw a ridiculously massive acceleration in the last 9 months. But it was happening before. So why would it reverse if it started before COVID? I think we got it all.
Yeah, I think so. Thank you so much, Neal. This was a lot of information. Thank you to everyone who joined in, Neal. I'm still trying to absorb all that information you gave. So I think everyone feels
you
the
guys.
same way. If you want to contact Neal, that's his details over there. And thank you everyone for joining. I hope this was useful. I will send out a recording in 24 hours, usually maybe 48. Please watch out for that, and also check out the YouTube channel for the recordings. I'll see you guys for the next webinar on Feb 17th at 7:30 p.m.
Sounds
Thanks.
good.
Thanks.
Over and out. Bye, everyone.
Bye.